Hi everybody, I'm here with Mathieu Roy, VP of Equities, and how are you doing today, Matt?
Great, yourself?
Doing good, sun's coming through. So Matt, can you get us a little bit caught up of what's been happening in investment markets and the economy in the recent couple months?
For sure. I mean, the last few years, minus last year, have been pretty good to investors. Equity markets in particular have been strong. Year to date, 2023, again, has been pretty good. A little to our surprise. We say that because central banks have been really trying to slow things down.
Yeah.
Inflation has been running it a little too hot. So we've been hiking interest rates with the idea of slowing down the economy so that inflation could cool off at the same time. This was the case again in Q3 for most of the period. The last few weeks of the month of September, we started to see that sentiment shift. So you had investors a little more worried that interest rates could stay higher for longer. If we don't see progress on the inflation front or employment starting to cool as well, we could have interest rates stay here for a more extended period of time. And that resulted in equity markets giving back some of those gains in the last few weeks of the month. Canada performed a little better than other geographies, in large part because we had a booming oil price. WTI, which is the North American version of the oil price, that went from $70 US to $90 US in 3 months. That has a big impact on Canadian producer cash flows, and that's a large part of our stock market. So it's a significant segment of the TSX. Still, it wasn't enough to bring the TSX in positive territory, but it did limit the damage because most of the other sectors were negative for the period. US and international equities did also benefit from higher energy prices for a component of their benchmark, but it's a much smaller component. So you had a much bigger impact by rising interest rates. So you had a lot of sectors which are interest sensitive, classic interest sensitive, like utilities, real estate, telcos, but also technology is a bigger component, especially in the US, and they have long dated cash flows. So you discount those cash flows with higher interest rates, it has a bigger impact. So that had a bigger impact on US and international equities. That's a bit of the landscape year to date and what's been going on over the last few months.
Okay, so that's a great summary of what we've been seeing in the rearview mirror. If we start looking ahead, what are we seeing currently, and what should we be looking towards the next couple of months?
Certainly. Well, we tend to agree more with the last few weeks of September. We felt, in general, investors, represented by the market, were a little too dismissive of the possibility that interest rates could stay higher for longer. And really, the central banks don't need to hike interest rates anymore. Just staying at these levels will have a restrictive impact on the economy. Renewing your mortgages, companies rolling over debt, it's real cost. It's going to affect decisions, and sometimes there's a delay. Inflation is coming down, but it's still too high. But employment is too strong. Really, central banks want to see employment fade. So, more jobless claims, less new job openings. That's going to have a positive impact on bringing wage inflation down. And that's really what the central banks want to see. So I think we're going to have to feel a little more pain in the economy before central banks move from restrictive to trying to stimulate the economy. And I think equities are only partially pricing that in. So from our perspective, it's a good time to be a little more conservative with the equity allocation, being at the average or slightly below the average. And it's not a bad time to do that. We spoke for years about the TINA trade. TINA meaning there is no alternative, meaning you had to buy equities because cash paid 0 and bonds were offering 1% to 2% yields. The positive side of this scenario here is we have alternatives and we can diversify and be balanced and have a good cash component, have a good fixed income component in various duration buckets, and also be invested in equities. But we don't have to be overly invested in this environment because we feel we're going to get a better opportunity. We could get some attractive buying opportunities, and we're very constructive for the midterm. So at some point, we just feel it might be a little later than other participants in the market. It could be later in 2024, difficult to say. We're going to see some progress in slowing down the economy, and then central banks have a lot of ammunition to stimulate. They've moved interest rates very high very quickly. They can do the same on the other side. And a few years ago, they couldn't do that because interest rates were already near 0. And that was a concern for us. So today, not at all concerned about the midterm in terms for equities. Feel that it's a good time to be balanced, not to be overly exposed today, because we feel that the economy has to feel a little bit more pain before interest rates come down.
Yeah, and investors could always follow suit. So of course, having a good balance always makes sense. So thank you very much. That was a great recap. I hope you guys enjoyed it. We'll catch you guys next time.
Thank you.
Yeah.